Hello. In this video, I'll be going through an introduction to accounting for income taxes. We've all seen by now a financial statement that includes the income statement. An income statement includes revenues. Typically, we see revenues minus expenses equals your net income, or it could be net loss. When we prepare the company's tax return, we do not necessarily use this net income as a basis to calculate how much they're going to owe on their tax return. There are going to be adjustments to the amount of revenue that we recognize for tax and adjustments to the expenses that we recognize for tax as well. And that's how we calculate the taxable income, calculate that by tax rate to get our tax payable for the year. So why do we have these differences between financial reporting and taxes? Well, the financial reporting or the financial accounting standards were established in order to provide useful information to investors and creditors, to the users of the financial statements. Congress established tax regulations, which are the rules that we have to follow for tax, in order to raise funds for the country, and it says influence the behavior of taxpayers. What this means is that there are tax rules set in place such that corporations do not enter into transactions solely for the benefit, for tax benefits. There has to be a business purpose for it. Now, I previously said that when we look at the financial income statement, we have the revenues and expenses, which may or may not be adjusted for tax purposes. And some of those revenues and expenses, when they're adjusted, they might be adjusted, but they will overall, over a period of time, they will still equal the same amount as what we've reported for financial reporting. They just will be reported at different time. So the issue is not whether an amount is taxable or deductible, it's whether when it's going to be taxable or deductible. And these kind of differences, the revenue and expense differences, are called temporary differences. Sometimes they're also called timing differences, simply because it's just a matter of timing as to when it's going to recognize for financial reporting versus when it's going to be recognized for tax purposes. Let's go through an example. Assume that Watson Associates generates $120,000 of income each year in 2027, 28, and 2029 before accounting for depreciation and taxes. Also assume that Watson purchases $60,000 of computer equipment in January of 2027, and that they estimate that the computer equipment has a useful life of 3 years and will depreciate that using the straight line method for $20,000 per year. So here on this first line, first section, we have financial reporting. And when we say financial reporting, we mean this is what you would see in the 10K. Sometimes I'll refer to this as book versus you'll see we'll go through the tax one. So we're going to start with income before tax and depreciation, and we're told it's $120,000 per year, right, for 3 years. So our total income before tax and depreciation is $360,000. Then we're told that for financial reporting, they depreciated this $60,000 asset over a 3-year span, so $20,000 per year, right? So we have $60,000 total depreciation at the end of 3 years, and the pre-tax accounting income is $100,000 per year. Now let's look as to what happens on the tax return, okay? We just went over the financial reporting. For tax purposes, there are different rules as to how to depreciate assets than financial reporting. And one of those rules says that you can actually accelerate your depreciation in certain circumstances to 1 year, to the year of purchase. The entire amount can be depreciated in 2027. So When we prepare our tax return, we're going to start in 2027, we're going to start with our income before tax and depreciation for $120,000, but we're going to take the full $60,000 of depreciation on the tax return. And so our taxable income, which is this line right here, ends up being $60,000. Our tax rate in this example is 25%, which means that our tax payable is $15. This is the amount, this is the current year liability that we're going to have to pay to the IRS or the states or whatever it is you're calculating for, okay? This is our current income tax payable, this $15 right here, okay? Let's just take it further to the other 2 years. The other 2 years, we still have $120,000 of income before tax and depreciation for each year. However, we don't take any depreciation at all because we've taken it all in 2027. So in 2028 and 2029, our taxable income is $120,000 multiplied by 25%, and our current tax payable in those years will be $30,000 for each of those years, okay? A few things I want to point out. You'll notice that for financial reporting, we've taken a total of $60,000 depreciation over the life of 3 years. For tax return purposes, we've also taken $60,000 of depreciation on the tax return over a period of 3 years. It's just a difference of the years that we took those, right? 2027, we had 20,000 versus 60,000 for tax return. In 2020 and 29, we had 20,000 for books and none for tax. But overall, we've taken $60,000 of depreciation expense for both financial reporting and the tax return. This is what we call, this is why we call the temporary difference. Depreciation is one of those items, those expense items that we adjust, but they're temporary because at the end of the day, at the end of these 3 years, we'll have taken the same amount for financial reporting and the tax return. It's just a matter of timing as to when we do it. Now, because we have, in this particular situation, accelerated the depreciation all into year 1 for tax return purposes, we therefore know that in the second and third year, in 2028 and 2029, we will have more tax due as a result of that, right? Because in the following 2 years for financial reporting, you have this $20,000 expense that you do not get to take for tax because we've already taken it, thereby resulting in a higher taxable income, thereby resulting in a higher tax. And when we have a temporary difference where we know that as a result in the future, we will have our tax payable will be higher, we're going to create what's called a deferred tax liability for the amount that causes that increase in tax, specifically for the depreciation amount. I'm not going to go through that in this video. There's whole other videos dedicated just to showing how to calculate that, but I want to introduce this concept in this video. So the deferred tax liability is recognized when activities reported in the current period income statement will produce future taxable amounts. So in this situation, our activities depreciation, if I could spell, right? We took more depreciation in the current year. So when we have a deferred tax liability, we have lower taxable income and therefore tax payable in the current period, right? Because we took more depreciation for tax purposes than we did for financial reporting, but that will result in higher taxable income in a future period. On the flip side, you can also have what's called a deferred tax asset, and that's recognized when the activities reported in the current period's income statement produces future deductible amounts. And that really can happen both for revenue and expenses as well, but it's easier to understand with revenues when when no revenues are recognized in the financial income statement, but they are recognized in the tax return. So then in the future, they will be recognized for financial reporting, but will be reversed for tax, resulting in future deductible amounts. And again, we're going to go into, there's a whole, I think, 2 different videos dedicated just for that. But deferred tax asset will result in higher taxable income and therefore tax payable in the current period, right? And on my revenue situation, I recognize the revenue for tax return purposes, but not for the financial reporting purposes. But in the future, we're going to have lower taxable income and therefore tax payable. Now, when we record this deferred tax liability and deferred tax asset, we have either a debit or credit, depending on what's going on. The other side of that journal entry is going to go to tax expense, okay? And that's reported in your income statement. Also, when I record my current tax payable, I'm going to go back to right here. When I record this $15, because my current year tax return says I owe $15, I'm going to credit current income tax payable as a liability, and my debit will also go to income tax expense. So the income tax expense is really a plug when you record your deferred tax asset, deferred tax liability, deferred tax asset, and your current income tax payable. The other side of that entry will be the tax expense.